It's a great pleasure to welcome Peter Krauth. Please enter the stage. He's the author of the best-selling book. Yes, why not? You have your fans here. Nice to see you.
Thank you.
He's the author of the best-selling book, as you all know, The Great Silver Bull. Krauth has written about and invested in silver and resources for more than 20 years. So without further ado, the floor is yours.
Thank you. Hello, everyone. Thanks for taking some time out to be here and to hear about silver. My talk today is Silver is the New Silver, and that's a little bit tongue-in-cheek, but the reason that I use that title is because silver has a reputation for being volatile, but also, of course, have a lot of alpha on the upside, and I think we're starting to see that now. And so I think it's a very good time to be invested in silver. Some people ask themselves, is it too late? And my answer is certainly not too late. It may feel like it a little bit with the run-up that we've had and that we're close to all-time highs, but actually silver's behavior and its price and how it's behaved over the last 50 years or so makes silver actually technically one of the all-time, once it breaks out above 50, makes it one of the all-time most, historical breakouts for any commodity, given the length of time that it has taken to go from an all-time high and eventually reach and take out that all-time high once again and move forward. It's the only metal, if you look at all the metals, it's the only metal that is not above its 1980 high. Everything else has surpassed it, and by far. So this one is going to be one for the record books. So we're going to talk a little bit macro and then jump right into silver. I think part of what we're seeing happen in silver right now is the inflation influence and silver's monetary aspects. So pre-COVID, we had inflation averaging about 1.5%, and I don't know if you remember, but I certainly do remember central banks and the Fed in particular saying how they wanted inflation at 2%, and that was their target, and they kept cutting rates. We had rates at or near zero for an extended period. We had negative real rates for an extended period. Gold and silver did okay during that time. Not as well as it's doing now, but they were anxious to get inflation back at 2%. COVID hit, and now it peaked at over 9% temporarily in July of 2022. We're back at an average now of around 3%. So inflation is technically about 50% or above their pre-COVID target. So I don't think we're seeing it going back to that anytime soon, although that remains their target. We'll see how that plays out. Some really interesting research from the University of Michigan, which looks at consumer behavior. And if you look at what 1 year inflation expectations were prior to COVID, we were somewhere around the 2.5–3% range. So even then, people felt some inflation being higher than what the reported sort of official inflation numbers were. Of course, they peaked after COVID, and yet we've had a very recent high peak, around 6.5%. This was in the wake of the tariffs debacle in the US that's dialed back. We're still at 4.8% right now. So that tells you something, that people really feel like inflation is nowhere near reported numbers of closer to 3%, but probably a lot more closer to reality, around 5%. And the idea is that the expectations are for rates to stay high like that. And I think that's why we're seeing that feed into precious metals. I also believe that this new inflation is structural and it's not going away. We're not going to ever be able to get it back, at least for quite some time, to rates that we've been accustomed to over the last couple of decades. You've got things like labor power in terms of pricing power by labor. You've got the end of globalization. You have the energy transition, and you also have renewed defense spending. All of these things added in start to increase what I believe is now a much higher structural inflation and is likely to be somewhere closer to 4%. I like to say that 4% is going to be the new 2% when it comes to inflation. So what do we have? We have the Fed, for example, cutting rates in the face of high and rising inflation. So really what they're doing is they're sacrificing the dollar to stimulate the economy. We had 2 million jobs that were revised away recently. Their stated inflation target of 2%, I believe they're just paying lip service to that target. They know they can't meet that anymore. We know that by cutting rates, that helps government refinance its debt. It helps them to pay less interest on their debt. We know that Trump, for example, wants a weaker dollar. He's been very, very vocal about that. Of course, that helps the economy at home. It helps to boost exports. It helps to discourage imports because people will pay for manufactured goods and services that are more local. I think we're basically heading back to negative real rates. And in this kind of environment where inflation is relatively high, let's say officially at 3%, and you have the Fed still cutting rates, that says to me that they've basically given up. All bets are off, and I think this is one of the big reasons that you're seeing precious metals starting to really take off. The public at large, the investor and the consumer at large is really seeing that baked in. Something that you may not hear or see too much about in mainstream is stablecoins. And I think this is something that people need to know a little bit more about and understand. So it's not specifically, let's say, related to silver, but I think it is related enough and it is important. Stablecoins are really cryptocurrency that's meant to mirror another currency, a fiat currency. And the idea is for stablecoins to become popular so that they're used instead of using regular fiat currency, because crypto does have advantages for transfer, the speed of transfer, and so on. So what I really want to talk about here is Tether. Tether is the world's largest cryptocurrency. It's a stable coin. Its goal is to mirror the US dollar, so it's priced at 1. And it's the world's largest with about $100 billion market cap. Most of Tether is backed by US Treasury bills. In fact, stable coins in the past year were the world's 7th largest buyer of US Treasury bills. So if anyone thinks that the market for T-bills is going away, maybe you want to look at some stable coins and see that maybe that's why they're being supported and encouraged by the current administration so much. It certainly makes for a ready market to buy T-bills. More importantly is what Tether has been talking about lately, and that is that they're making a new commitment to tangible assets, and yet they're supposed to be tied to the US dollar and backed by T-bills, which is mostly their backing. But now they've already got 5% of their backing in physical gold. They're looking at augmenting their exposure to gold, for example, and the whole gold chain of gold extraction, refining, trading, royalty companies. And recently they bought into a large stake in a company called Elemental Altus Royalties. Elemental has now merged with EMX Royalties. Tether is a 33% holder of this new combined company, has invested $100 million so that they can go out and look for more royalties to add to their stakes. So you really have to ask yourself what's going on if a stable coin that is meant to reflect a fiat currency is going out now and making a vocal and very impactful moves into the gold space and tangible asset space. And this is something I thought was kind of fun. Here's one stable coin that I have. I bought this in 2013, and although it's supposed to be stable, it's down about 50%. So if any of you own some of these stable coins, you're probably having the same experience. So let's move to silver now. Why silver? Well, I think a lot of the what's going on in silver and what's influencing silver and pushing the price higher has to do with what I call the 800-pound gorilla in the silver market, and that is solar. And if you look back at predictions of solar installations, the International Energy Agency's World Economic Outlook, has a dismal record actually at predicting solar installations versus what actually took place. So throughout the 2010s, every year they would predict for the next 5 years what solar installations would be. And they were typically 1/3, their predictions were 1/3 of actual final installations. So their forecasts were under by 200%. So that tells you how much solar has become important. It consumes 20% of all of the silver that's produced every year, or that's brought to market, not even just produced, but silver made available to market. So solar is really the big player on the industrial side. And it's only going to become more important because the demand for power by data centers is growing nearly exponentially. You've got 20% annual growth for electricity by data centers. And now, if you layer on top of that AI, the demand for AI electricity is growing at a 33% growth rate. Interesting to note is that an AI query will take 10 times as much power as a Google search. And so you can just from that, you can get some idea of why and how the demand for electricity from AI is really going to push things a lot higher. So where are these tech giants getting their power? Well, a lot of them want to remain green and have carbon-free or carbon-neutral power sources. I've been saying since about 1.5 years that they're going to turn to solar. I've gotten some pushback on that for understandable reasons. You know, the pushback came from arguments saying that they're going to go to nuclear, for example, because that's base load and also carbon-free. But what we've seen is that solar has been about 3 times the uptake of wind and about 5 times the uptake of nuclear. And what we have seen is also that the larger players, Microsoft, Meta, Apple, for example, to some extent they've gone to nuclear. That made sense for them. They wanted baseload power, but they've been able to go to nuclear where there was excess capacity. And that's not going to be the case for the next tier down from the Magnificent Seven, for example. And if you look at how long it takes to deploy nuclear versus solar, it's nearly 10 times. So to get nuclear approved, built, and so on, you're looking at 15 years. To get solar approved and built, you're looking at about 1.5 years. And solar, really, if you don't need to tie into a utility. You can be completely independent. If you build a solar power plant next to your data center, you're completely off the grid. You're basically self-reliant. And so that's very attractive. But I think that the real game changer for solar, and especially when it comes to demand by AI and data centers, is batteries. Over the next 10 years, it's expected that the levelized cost of batteries is going to drop in half. And we've already seen batteries deployed to the tune of 60% this year of 2023 solar capacity installations. So that tells you there's a lot of uptake of batteries in order to help make solar baseload power, which makes sense. Solar will produce during the day, but if you can store some of that excess capacity and that could be drawn down at night, then you have your constant power supply and you have essentially baseload power. And solar is a cheap source of power that way. We know that there's talk about silver potentially being deemed a critical metal. Some think it has been by the US. That's not the case. At this point, what they've done is they've put it on their list for consideration as a critical metal. We're probably going to find out in the next few weeks or so whether it makes that list or not. But to give you some perspective, the US imports 43% of the silver that it consumes every year. So they're certainly quite reliant on imported silver. If you want to look at whether silver is expensive or cheap relative to different assets, if you look at the broader stock market, for example, we're at what I would consider quite a low. Around the late 80s, mid to late 80s, silver peaked versus the S&P. It bottomed in 2001. It was very cheap. In 2011, when it reached $50, it was relatively expensive to the S&P, and now we're in a bottoming phase right here. right now. And so even at our current $48, $49, silver's looking still quite cheap, certainly compared to stocks. We've seen central banks start to buy silver. Russia, the central bank of Russia, said last year that for the next 3 years it was going to add silver to its reserves. We recently saw that the Saudi central bank has bought $40 million worth of this SLV ETF and the SIL Global X Silver Miners ETF. So that's a drop in the bucket for the Saudi central bank, but it gives you some indication of what's going on in that sector of silver buying. Quickly talk a little bit about the gold-silver ratio. So really what the gold-silver ratio is how many silver ounces it takes to buy 1 gold ounce. And the lower the ratio, the less silver ounces it takes. Well, over time, that ratio has changed. If you go back to 2000, it averaged about 69 ounces of silver for 1 of gold. Since 1970, it averaged 60, and since 1900, it averaged 52. Now, as you can see, I didn't update this slide today, but because I used $3,700 gold. But if you use the average of the gold-silver ratio back to 2000 at 69, that would put us today at a $3,700 gold price at $54 silver. So if anyone thinks that silver is not going to, at some point soon, go through $50 and maintain that, this certainly bodes well for that. And this is a little busier chart. Again, the gold-silver ratio going back to the 1980s or so. And what we see is that, what you can take away from this is that the ratio tends to peak at sometimes above around 100 or so, but typically it peaks around 80 and then it drops. And if you see it go above 80 and then drop back down and cross through 80, then chances are silver is moving a lot more quickly, a lot higher, a lot more quickly than gold is. We've seen it bottom a few times around 50 or so. That bottom at 32 right here was in 2011 when silver reached $50. I think that it's very reasonable to look at silver at a 55-to-1 ratio, and at $3,700 gold, that would put silver at $67 for about a 40% gain still from here. So there's plenty of upside. This is an interesting chart. This is from Incrementum, but I had produced this originally, and it looked at how silver behaves in rate cutting cycles by the Fed, the US Fed. And what I saw was that silver tends to bottom when the Fed is about halfway through its rate cutting cycle. So we know that the Fed started cutting rates in September of last year, then paused earlier this year, and has started again recently. So you could assume that we are perhaps around halfway through the rate cutting cycle. Well, the behavior of silver in the average of the last 3 rate cutting cycles had silver produce a 332% gain from the bottom, from the middle of that rate cutting cycle to its eventual peak, which was anywhere from maybe 12 to 24 months later. If you use the low of last year, $22 silver in February of 2024, that would put silver at $95 in this cycle. So, who knows? That could be where it's going over the next year or two. General investors, I think, are starting to come back into the virtual/physical silver space. Bullion dealers will tell you that they're not buying that much, but selling that much silver, but the investors are certainly buying into the SLV ETF. So why would you want silver stocks? The silver mining industry is tiny. We're looking at about a $50 billion market cap overall versus the gold mining industry at $950 billion. So the silver mining industry is just 5% of the gold mining industry. That's why when money really moves into this space, it has huge impact. The potential is massive. Silver is up about 105% since the low of February last year. The SILJ is up 180%. It's probably more now, but that gives you some idea of the potential. If you look at some of the previous bull analogs going to 2000, we could be up 4x from where we currently are in silver junior stocks to meet the to match the 2004 to 2007 rally we had in junior silver stocks. And one last chart to give you some idea of the potential. This blast off here was in 2016. Silver was up 45% in about 7 months. The SILJ was up 350%. That's about an 8 times leverage in a span of 7 months. So just very quick background. I publish a newsletter called Silver Stock Investor. It's the only silver-focused newsletter that I know of in the market. We've done well. We've taken profit on 7 doubles this year, and I think it's still very early. There's lots of upside ahead. And you can go to Silver Stock Investor or the Gold Advisor, our portal website, where we have all the newsletters that we publish there. Thanks very much.
Well, thank you.